The market just delivered a masterclass in why human psychology creates exploitable patterns. Tuesday's 2% sell-off wasn't random volatility, it was the predictable result of a crowd that had grown too comfortable with certainty suddenly facing the unknown. Here's what most traders missed. For weeks, the market had been pricing in continuity, extending the same momentum trades that worked in 2025. Then, Trump announced tariffs on NATO allies over Greenland and threatened to cap credit card rates. Suddenly, investors couldn't distinguish policy from spectacle. The rules they thought they understood became opaque overnight. This psychological shift from complacency to confusion created immediate mechanical responses in the system. Large-cap technology became the release valve. Nvidia dropped 4.5%, Broadcom fell 5.5%, Oracle shed nearly 6%. This wasn't about fundamentals deteriorating, it was position unwinding when participants couldn't model the new game. The bond market told the real story. The 10-year Treasury yield surged to 4.3%, its highest since August. But here's the key insight. Bonds and stocks fell together. This wasn't typical risk-off behavior where bonds rally as equities decline. Both asset classes sold off simultaneously, signaling concerns about fiscal credibility and foreign capital flows. Meanwhile, small caps outperformed large caps for 11 straight sessions. Capital was rotating toward companies with domestic revenue exposure insulated from cross-border complexity. The Russell 2000's resilience showed investors seeking refuge in businesses they could actually understand and model. Gold's move above $4,600 per ounce wasn't about inflation. Core CPI remained anchored near 2.6%. This was flight from legibility itself. When markets can't trust their own pricing mechanisms, precious metals become the expression of that uncertainty. The credit card rate cap proposal revealed how quickly regulatory risk can materialize. Banks that had just reported strong earnings were punished not for performance, but for policy exposure. Goldman Sachs and Morgan Stanley rose on investment banking strength, while retail-focused banks like Wells Fargo fell on the regulatory overhang. The VIX spike to 21 marked the transition from complacency to caution, but remained below systemic stress levels. Volume surged above the 20-session average, indicating genuine repositioning rather than illiquid price action. This is exploitable because the crowd consistently mistakes stability for permanence. Participants who assumed 2025's playbook would extend indefinitely are now confronting reality. Regime shifts don't announce themselves with advance notice. The Stoic approach recognizes that volatility isn't an anomaly, but the baseline condition of complex systems. Tuesday's sell-off wasn't a breakdown, but a recalibration. When geopolitical risk becomes nonlinear, markets must reprice not just probabilities, but the entire distribution of outcomes. The correction in megacap technology was overdue. Valuations had extended beyond what fundamentals could justify in a higher-for-longer rate environment. When the 10-year yield approaches 4.3%, the present value of distant cash flows compresses. This is arithmetic, not sentiment. The rotation into small caps and value stocks reflects a market beginning to price differentiation rather than correlation. For months, the Magnificent Seven carried the indices. Now breadth is expanding, and performance is dispersing. Concentration risk was the silent vulnerability of last year's rally. Systems that depend on stable rules are fragile. Systems that adapt to rule changes are robust. The Danish pension fund's reported Treasury reduction represents broader concerns about foreign holders diversifying away from U.S. debt. If this trend continues, the cost of capital rises and discount rates adjust accordingly. The Fed's pause is correct. Inflation remains above target, the labor market is stable, and the economy is growing. Political pressure on the central bank is noise. The data is signal. Markets that move create edges. Markets that drift do not. The past week reminded us that price discovery is a process, not a destination. Those who embrace uncertainty as the natural state will be prepared when others are surprised. Volatility has returned, and with it, opportunity. The question isn't predicting the next catalyst, but positioning for a range of outcomes while the crowd scrambles to understand rules that are still being written. If you value systematic thinking over emotional reactions, subscribe for frameworks that exploit human predictability. Download the complete Stoic exploiter methodology in the description because discipline beats hope every time.